Welcome back to our three-part series, Understanding Financial Statements. Here, we're decoding the numbers that tell the real story behind every company, teaching you the language of business. It's essential because when you buy a stock, you're not just trading a ticker symbol, you're purchasing a piece of a real business. This series is for investors who want to look past market hype and truly understand the fundamentals of what they are buying. In episode 1, we explored the income statement. We saw how it tracks revenue and expenses over a period, like a quarter or a year, to reveal a company's profitability. It's a dynamic report card on performance, but performance is only half the story. While the income statement is like a movie showing earnings over time, today's topic, the balance sheet, is a single crucial photograph. It provides a snapshot of a company's financial position at one specific moment, revealing exactly what it owns and what it owes. In short, it tells us what the company is fundamentally worth. It all boils down to a simple but powerful accounting equation. Assets, tron, liabilities, plus equity. We'll break that down piece by piece. So, stick around. By the end of this video, you'll not only know how to read a balance sheet, but also how to use it to assess a company's financial structure and stability before you buy a single share of stock. If you want to invest wisely, this document is your essential X-ray. It lets you see through the noise of daily price swings to the solid foundation beneath. It's your clearest view into what a company owns, what it owes, and ultimately, the value that belongs to its shareholders at a single point in time. Let's start with the balance sheet. Think of it as a detailed financial selfie, capturing a company's exact position on a single day, like the last day of the year. Unlike an income statement, which is like a movie showing performance over time, the balance sheet is that one critical, frozen frame. It's a static but comprehensive snapshot. It's structured to answer three fundamental questions. First, what does the company own? These are its assets. This includes everything from cash and inventory to valuable machinery and property. These are the resources the company uses to operate and grow. Second, what does the company owe to others? These are its liabilities. This covers all its debts like loans from a bank or money owed to suppliers. And third, after all debts are settled, what's left for the owners? This is the shareholders' equity, representing the owner's stake in the company. These three parts are connected by the foundational accounting equation. Assets, farmers' liabilities, plus shareholders' equity. This equation must always balance without exception. That's because every single asset the company owns had to be funded from one of two sources. It was either bought with borrowed money, a liability, or with capital from its owners, equity. This simple, powerful logic is the bedrock of double-entry bookkeeping. Let's start with assets. These are the resources a company owns that have economic value, powering its operations and growth. On a balance sheet, assets are listed by liquidity, how easily they convert to cash. This divides them into two key groups, current and non-current. First, current assets. These are resources a company expects to convert into cash within 1 year to fund daily operations. The main types include cash and cash equivalents, the most liquid form used to pay bills. This includes money in the bank and highly stable short-term investments. Next, accounts receivable. This is money owed by customers for goods or services already delivered. And finally, inventory, goods waiting to be sold, from raw materials to finished products. For example, if you run a small coffee shop, the cash in your register, the coffee beans on the shelf which are your inventory, and the invoices for catering jobs, your accounts receivable, are all current assets. Then, we have non-current assets. These are long-term investments that help a company make money over many years. They aren't for quick sale. They include property, plant, and equipment. The tangible workhorses like buildings, trucks, and machinery. Their value is gradually reduced over time through depreciation. Next, intangible assets. You can't touch these, but they're incredibly valuable, like patents, software, or brand value. And finally, investments in other companies or long-term securities. For Tesla, its massive gigafactories and the robotics inside are prime non-current assets. For Apple, its most valuable non-current assets are intangible. Its design patents, proprietary software, and its globally recognized brand, which commands incredible customer loyalty. For investors, a growing asset base can mean a company is expanding. But the of those assets is key. You want to see growth in productive assets that generate revenue. A major red flag is when inventory piles up faster than sales. This ties up cash and signals a potential drop in customer demand, which could force the company to sell products at a loss. Next up, liabilities, the debts and obligations the company must pay. Like assets, they're divided into 1. Current liabilities, due within a year. Examples, accounts, payable, short-term loans, accrued expenses. 1. Long-term liabilities, obligations due in the future. Examples, bonds, payable, long-term loans, pension obligations. A company with too much debt may struggle when interest rates rise. But some debt can be a good sign. It often means the business is confident in its ability to grow. Finally, we have shareholders' equity, what's left for owners after all debts are paid. It includes common stock, money invested by shareholders, retained earnings, profits the company has kept and reinvested, treasury stock, shares the company bought back. Think of it like your home equity. If your house is worth $300,000 and you owe $200,000, your equity is $100,000. The same principle applies here. Now, why should investors care? Because the balance sheet helps you judge a company's financial strength and risk level. Here's what to look for. 1. Liquidity ratios, like the current ratio, current assets, current liabilities. A ratio above 1 generally means the company can pay its short-term bills. 1. Debt-to-equity ratio. How much of the company is financed by debt versus owners? Lower is safer, higher can mean higher risk, or higher potential reward. 1. Asset growth. Is the company expanding its productive base or just piling up debt? Let's take a quick look at Apple's balance sheet as of a recent year. Total assets, around $380 billion. Total liabilities, around $280 billion. Shareholders' equity, about $100 billion. That means Apple has more assets than debt, a strong sign of financial stability. It can invest in R&D, buy back shares, or weather economic downturns without panicking. The balance sheet doesn't stand alone. It connects directly to the income statement and the cash flow statement. The income statement shows performance over time. The balance sheet shows financial position at a moment. The cash flow statement shows how money moves in and out. Together, they form the full picture of financial health. Understanding the balance sheet helps you spot companies built on sound financial grounding and those balancing wailing on a financial thin and shaky tightrope. So before you invest in a stock, always check, does this company have the assets to survive a storm? Or is it drowning in debt beneath a glossy profit report? If you found this helpful, don't forget to like, subscribe, and hit the bell icon, so you won't miss episode 3, where we'll break down the cash flow statement, the lifeblood of any business.